Hey everyone, and welcome back for another deep dive. Today, we're going to be looking at Muthoot Finance Limited, an Indian financial services company, and we've got a whole stack of their official reports and disclosures. These are straight from the regulatory bodies in India. So we're getting a real inside look at their performance, what they've been up to. And let me tell you, things get interesting pretty quickly, just to pique your interest. In August 2024 alone, they issued over 1.2 billion US dollars worth of debt. That's a lot of borrowing.
Yeah. It's really fascinating to see these documents, to get this kind of raw, unfiltered view into the company's inner workings. It's almost like peeking behind the curtain a little bit
Mhm.
and seeing the financial machinery in action.
Okay, but let's start unpacking this then. First things first, can you give us a quick rundown of what Muthoot Finance actually does?
Sure. So Muthoot Finance is Muthoot, primarily in the business of lending money, specifically gold loans. They're a major player in India based out of Kochi, and they operate solely within the financing sector.
Okay, so they're laser focused on lending. That simplifies things a bit for us, right?
Absolutely. It means that we don't have to break down their financials by different business lines. We can just focus on those core lending operations and see how they're performing.
All right, so let's do a financial health checkup then. What can you tell us about their assets and liabilities?
Well, looking at their statement from September 30th, 2024, the first thing that jumps out is the significant growth in loans compared to March 31st, 2024, which was just 6 months earlier. This is a strong indication of a lot of business activity.
Okay, so they're lending out a lot more money, but where's all that cash coming from?
Yeah, that's the key question. To understand that, we need to look at their borrowings and comparing this to previous periods. It shows us how they're financing those operations, and it looks like they're not shy about using debt to fuel their growth.
Okay, that makes sense, but doesn't borrowing money come at a cost?
Absolutely, that's
Yeah.
where we need to look at their statement of financial results. So, while their revenue from interest income and service charges is up, so are their finance costs, which is essentially what they're paying to borrow money. And then there's another factor to consider: impairment on financial instruments.
I have to admit, that one sounds a bit intimidating. What does that actually mean?
Yeah, it's think of it as setting aside money for a rainy day. It's an allowance for potential losses
Yeah.
from loans that might not be repaid. It's just the reality of being in the lending business. Not every loan is a winner.
Okay, so it's a way of acknowledging the risk involved in lending. And how does Muthoot's cash flow look?
That's where things get even more intriguing. Their cash flow statement shows that the cash generated from their core operations was actually negative.
Wait,
That
negative? Isn't that a bad sign?
It can be. Imagine Muthoot as like a race car,
Yeah.
speeding around the track. Negative cash flow from operations means that they're burning through fuel faster than they're filling up. And it raises questions about how long they can keep going at that pace.
Okay, now I'm a little concerned. But did you mention earlier that they're borrowing a lot of money? Wouldn't that boost their cash flow?
You're right, their cash flow from financing activities, which includes borrowing, is significantly positive. So they are bringing in money, but it's coming from those outside sources, not from their core lending business.
Okay, so they're relying on debt to keep the engine running. But what about the bigger picture? Don't they have subsidiaries too?
Exactly. To get a really complete picture of Muthoot's financial health, we need to look at their consolidated financials, which include their subsidiaries. So this brings companies like Muthoot HomeFin and Belstar Microfinance into the mix, and it gives us a broader view of their overall performance.
All right, consolidated financials. Got it. Now, before we get too deep into those, what about their compliance with regulations? Are they playing by the rules?
Yeah, that's a crucial question. The auditor reports give us a pretty good idea of that. And in Muthoot's case, the auditor specifically confirmed that the company has enough assets to back up their outstanding debt.
Okay, so
Yeah.
it's like a safety check for investors. They want to know that Muthoot can actually pay back what they borrow.
Exactly. It helps maintain that investor confidence, which is really crucial for any company that relies on borrowing to finance their operations.
Okay, that makes sense. And I know that there's a lot of regulations surrounding financial reporting. Are there any specific disclosures we should be aware of?
Absolutely. There are certain disclosures required by Indian regulations. These give us a peek into key financial ratios, like their debt to equity ratio, which tells us how much they're relying on borrowed money compared to their own funds, and their net profit margin, which shows how much profit they're making for every dollar of revenue.
Okay, so these disclosures help paint a more detailed picture of their financial health. beyond just the raw numbers.
Precisely. It's like getting a behind-the-scenes look at how they manage their finances and the strategies they're using to grow their business.
All right, so we've covered a lot of ground here. We've gotten a glimpse into Muthoot's operations, their financial performance, and their compliance with regulations. But I have a feeling there's still a lot more to uncover.
Oh yeah, we've only just scratched the surface. In the next part of our deep dive, we'll dig into those fascinating details hidden within these documents, explore the intricacies of their financing strategy, their risk management practices, and the potential challenges and opportunities that lie ahead.
I'm ready for part two. Welcome back to our deep dive into Muthoot Finance. In part one, we got a good overview of their operations, financials, and compliance. Now, I'm ready to roll up my sleeves and dig into some of those intriguing details you mentioned. Where should we start?
Well, remember that massive amount of debt Muthoot issued back in August 2024? Those non-convertible debentures worth over 1.2 billion US dollars.
Yeah.
Yeah, that's a good place to start unraveling their financing strategy.
Okay, so they're tapping into the debt market to fuel their growth. But what does that actually mean for the company? Is it a smart move or a risky gamble?
Well, it's a bit of both. On the one hand, issuing debentures allows Muthoot to access a huge pool of capital, which they can then use to expand their lending operations. It's a pretty common tactic for financial institutions that are looking to grow quickly.
Okay, so more capital means they can issue more loans, potentially leading to higher profits.
Exactly. But there's a catch. Remember those finance costs we talked about earlier? Well, taking on more debt also means higher interest payments, which eat into those profits.
Ah, so it's a balancing act. They need to make sure the returns from their lending activities outweigh the cost of servicing that debt. What happens if interest rates go up?
That's a cauldrous. Key risk to consider. If interest rates rise, those finance costs could climb significantly, potentially squeezing their profit margins.
You know, it's like walking a tightrope. They need to carefully manage that debt burden.
It's making me think of those high wire acts at the circus. One wrong step and
It's
that's...
all over.
Yeah. It's a good analogy, and that's why understanding these details is so important. It helps us assess not only their current performance, but also anticipate, those potential challenges down the road.
All right, let's shift gears a bit and talk about those regulatory disclosures you mentioned. What kind of insights can we glean from those?
Well, one of the key disclosures
Oh.
is their debt-to-equity ratio, which as of September 30th, 2024, stood at 2.82. Think of it this way. Imagine Muthoot is balancing on a seesaw. On one side is the money they've borrowed, and on the other side is the money invested by shareholders. That ratio of 2.82 means they're leaning pretty heavily on borrowed funds.
Okay, so a higher ratio means they're relying more on debt than on their own resources.
Exactly. And while it's not necessarily a bad thing in itself, a high debt burden can make a company more vulnerable to economic shocks or interest rate hikes. It's definitely something to watch closely.
Makes sense. Now, what about their profitability? What can we learn from these disclosures about how ethically they're generating profits?
Well, another important metric is the net profit margin, which tells us how much profit they're making. For every rupee of revenue they earn, Muthoot's net profit margin for the quarter ended September 30th, 2024, was a healthy 30.32%.
Wow, over 30%. That sounds pretty impressive.
It is. A profit margin that high suggests that they're managing their costs well and generating a substantial profit from those lending operations. But remember, we need to factor in those finance costs and the impairment on financial instruments when assessing their overall profitability.
Right, those costs can definitely impact their bottom line.
Yeah.
Are there any other key ratios we should be paying attention to?
Absolutely. The disclosures also reveal some sector-specific ratios that provide insights into Muthoot's risk management practices. One is the net stage 3 loan assets to gross loan assets ratio, which stood at 4.30% as of September 30th, 2024.
Okay, break that down for me. What are stage 3 loan assets?
So, think of them as the loans that are causing the most worry. These are loans that the Reserve Bank of India has classified as loss assets, meaning they're considered very likely to result in a financial loss for the lender.
So it's the percentage of loans that are essentially going bad.
Exactly. A lower ratio is generally better because it means fewer of their loans are considered high risk. In Muthoot's case, that 4.30% might seem relatively low, but it's crucial to compare it to industry benchmarks and track its trend over time.
It's like checking their temperature regularly to make sure they're not running a fever.
Precisely. Now, another important ratio is the provision coverage ratio, which came in at 14.52%. as of September 30th, 2024. This tells us how well Muthoot is prepared for potential losses on those troubled loans.
So it's a measure of how much they've set aside to
Yep.
cover those potential losses.
Exactly. A higher ratio generally indicates a more prudent approach
Sure,
to risk management. They're acknowledging the possibility of losses and taking steps to cushion the blow.
Okay, so we've got those two key ratios, the net stage 3 loan assets to gross loan assets and the provision coverage ratio, both giving us clues about how Muthoot is managing their risk. What else can we learn from these financial statements?
Well, let's zoom out a bit and look at the consolidated financial statements, which, as we discussed earlier, incorporate the performance
Yeah.
of Muthoot's subsidiaries. One interesting detail that pops out is the inclusion of Asia Asset Finance PLC, their Sri Lankan subsidiary.
Oh, so they're not just playing the India market. They've got some international ambitions as well.
That's right. Although their Sri Lankan operation is relatively small compared to their Indian business, it does signal their interest in expanding beyond India's borders.
It makes you wonder what other markets they might be eyeing for future expansion.
Indeed. And when we look at the consolidated figures, we see a substantial increase in borrowings compared to the standalone numbers. This suggests that their subsidiaries, particularly those in microfinance and housing finance, are also leveraging debt to fuel their growth.
So it's a family affair. Everyone's borrowing to grow.
I'd say common strategy in the financial services industry. But as we've discussed, leveraging debt amplifies risk. If those subsidiaries run into trouble, it could have a ripple effect on the parent company.
It's all interconnected, isn't it? The performance of those subsidiaries can directly impact Muthoot's overall financial health.
Absolutely. And speaking of interconnectedness, let's not forget about the consolidated cash flow statement. We see a significant negative cash flow from operations here as well, mirroring what we observed in the standalone statement.
So once again, they're spending more cash than they're generating from their core business operations. That's concerning.
It definitely warrants careful scrutiny, while there can be valid reasons for a negative cash flow from operations, especially for a company investing heavily in growth. It's crucial to understand those reasons and assess whether those investments are likely to pay off in the long run.
It's like a startup burning through venture capital to build their product and acquire customers. The hope is that they'll eventually become profitable, but there's no guarantee.
Exactly. And that uncertainty is part of what makes analyzing these financial statements so intriguing. We're piecing together clues to try to understand the company's strategy and assess their chances of success.
It's like we're financial detectives.
I like that analogy.
All right, so we've uncovered some fascinating details about Muthoot's financing strategy, their risk management practices, and the performance of their subsidiaries. What key takeaways should we keep in mind as we head into the final part of our deep dive?
Well, we've seen that Muthoot Finance is a company on the move, aggressively pursuing growth, both in India and abroad. They're not afraid to use debt to fuel that expansion, but that approach also carries inherent risks.
It's a high-stakes game they're playing.
Yeah.
What else has stood out to you?
The importance of consolidated financial statements can't be overstated. They provide a much more complete picture of a company's operations, including the risks and rewards associated with their subsidiary.
It's like looking at the whole forest instead of just a single tree.
Exactly. And in the final part of our deep dive, we'll explore how all these pieces fit together and examine the potential implications for Muthoot's future trajectory.
We're back for the final part of our Muthoot Finance deep dive. We've gone through their financials, their growth strategies, and even peeked into their risk profile a bit. Now I'm really curious to see how this all ties together.
Yeah, one of the things that makes this case study so interesting is how Muthoot's choices connect with the regulations in India. Remember that auditor statement? Confirming they have enough assets to cover their debt, that really speaks volumes about how closely India's financial system is watched.
Yeah, it's reassuring for investors, knowing there are those safeguards in place.
Absolutely. India's regulators, especially the Reserve Bank of India, they're really key players in keeping the financial system stable and making sure companies like Muthoot are playing by the rules. This can be both a hurdle and a helping hand for them.
Oh, a hurdle, because they have to jump through all those regulatory hoops.
Yes, but it's also a benefit because it builds trust with investors. When investors see a company operating in a well-regulated environment, they're more likely to feel confident putting their money there.
Okay, it's a delicate balancing act, navigating regulations while still trying to grow and expand. And Muthoot certainly seems to be a company that's not afraid of ambitious growth, even if it means taking on a lot of debt.
Right. And that's where things get really interesting. Their strategy of using borrowed money to fuel their expansion needs to be very carefully aligned with those regulatory requirements
They can't just go on a borrowing spree.
without consequences, right? Exactly. The Reserve Bank of India sets prudential norms like capital adequacy ratios and provisioning requirements to keep institutions like Muthoot financially sound. These act as guardrails, making sure they have enough reserves and set aside enough to cover those potential losses.
So those finance costs and impairment on financial instruments we talked about earlier are directly tied to meeting those regulatory requirements.
Precisely, managing those costs effectively while still making enough profit to meet those regulatory capital requirements is a major challenge for Muthoot, particularly because they're so reliant on borrowed money to fuel their growth.
It sounds like they're constantly walking a tightrope,
Mm.
trying to maintain that delicate balance between growth and risk.
Yeah, that's a great way to put it. And that brings us to the big question: what does the future hold for Muthoot Finance? Their aggressive growth strategy has clearly been successful so far, but it does come with a level of risk that can't be ignored.
So what factors could potentially rock the boat for them?
Well, there are several external forces that could have a big impact on their performance going forward. Interest rate changes, for example, could dramatically affect their finance costs and squeeze those profit margins.
And we can't forget about the overall economic climate either. An economic downturn could lead to more loan defaults, which would put more pressure on their asset quality and those provisions they've set aside.
You're absolutely right. Those sector-specific ratios we discussed, the net stage 3 loan assets to gross loan assets, and the provision coverage ratio become even more crucial to watch in those situations.
It's a complex web of all these interconnected factors: their strategic choices, their financial performance, the
Yeah.
regulatory landscape, the broader economic environment, all playing a role in shaping their future. It's amazing to see how it all ties together.
And that's what makes these deep dives so fascinating, isn't it? It's not just about crunching numbers, it's about understanding the
Yeah.
bigger picture and how all these different elements in our...
Well, it's time for us to surface. From our exploration of Muthoot Finance, we've uncovered a lot of information, from their impressive growth to those potential risks lurking beneath the surface. But like any good deep dive, the real learning continues, even after we come back up. What advice would you give to our listeners who are interested in continuing this exploration?
I'd say the documents we've analyzed are just one piece of the puzzle. I encourage everyone to stay curious, research industry trends, look at what Muthoot's competitors are doing, think about how changes in the global economy might impact their performance. There's always more to learn.
That's what I love about these deep dives. They spark a thirst for knowledge and give us the tools to navigate the financial world with a more informed perspective. Until next time, keep exploring.